You're listening to the Annuity Agents Podcast with Anthony Owen. Anthony is the co-founder of a $20 million per year annuity agency, president of Annuity Agents Alliance and Annuity Innovation Systems, co-founder of Safe Money Radio Marketing, and monthly contributor to Think Advisor. Each week, Anthony and his partners at Annuity Agents Alliance update you on the annuity business with marketing, sales tools, sales process, and case design strategies. Before we get started, hit that like button and subscribe so you don't miss information that will help you build your annuity business.
Hello, everyone, and welcome to this episode of the Annuity Agents Podcast. Thanks for joining us today. If you'd like to get a copy of the notes, you can go to annuityagentsalliance.com and click on podcast, or look for the link next to the recording or the podcast that you're listening to this on. While you're there, go and give us a like or a comment or anything that you'd like to do to help us get a little attention for this. We'd really appreciate it. Today we have Scott Soares with us, and we're really happy to have him. I think one of the biggest missed opportunities in this business is asset-based or hybrid-based long-term care. And so we're going to be focusing on that a lot this year. You'll probably hear me push it over and over again. And it's a great add-on sale. It avoids a lot of suitability issues once you've done your annuity sales. And it's also a very underserved component of our financial planning process, and super important. Nothing can wipe out someone's retirement faster than long-term care costs. So Scott Soares is our expert at life and LTC, and we use him constantly to support our agent partners. And those that work with him really enjoy his service. So we're going to go over several different products today. This is going to be more product focused rather than a lot of sales talk. But remember that if you're servicing your clients in the way that you should be, then you are selling. So Scott, why don't we start off with this National Western Life Life Return Select. Maybe you can just go into some of the benefits of this product, kind of strip it down, nuts and bolts. Sure. And then we're going to be kind of scrolling through these notes. Once again, if you're not watching us on YouTube, look for the notes link so that you can follow along with us. Scott, why don't you go ahead and take it away?
Yeah, I was just going to say, I'll touch on traditional long-term care. If you've been in the business, any number of years, you know that it's been priced out of the market. We've got a couple policies that are still out there right now. We used to have, 50 to sell 10 years ago. So low interest rate environment has basically killed off the traditional long-term care. So people put their brains together and came up with, using life insurance in these hybrid products. So I'm excited about them. I think they're, like you said, Anthony, they're a great add-on sale. If someone is not using the money for income or doesn't need any more annuities, here's the direction you kind of want to look towards. And I'm here to help at any point. So first one is National Western Life Select Return. It is actually one of the most liquid policies out there and one of the most simplest, actually. It's a 15-minute interview and it's an instant decision. So at the end of the 15 minutes, and it's not 30 or 45 minute, like a regular fully underwritten product. This is simplified issue. So 15 minutes. We have the knockout questions for you. So we've got the health questions and the prescription questions. So going into this, whether, 95% of it, you'll know whether they're going to get approved or not. So just a great, simple product to explain as well. It's that lazy money sale. I always bring this up. If you've ever talked to me before, it's the left pocket, right pocket sale, right? We're just moving money from your left pocket to the right. a bank, say it's in a CD or a savings account, and you ask that client, hey, Mr. Client, what's this money over here for? What's this 100 sitting here? 99 times out of 100, it's for emergencies, or I just want to give it to my kids or my grandkids. So let's move it from a bank to an insurance company. And for, let's just say, I think the example we used was 250,000, but 250,000 buys this 70-year-old female 370 of insurance guaranteed. But if you know life insurance, we always have a guaranteed side and a non-guaranteed side or current side. So you can see actually on the current assumptions, it's actually buying her 487,500. The way this works for the long-term care aspect of it is 2% of the face amount. So if you go up one more, go back up to that slide, Anthony. Yeah, you can see she'll get 7412 a month for 50 months. If she accelerates all of the money, so she uses the whole thing up and uses all the death benefit up, they'll still have a residual policy of 12,500 as a burial policy. The biggest selling point of this is the return of premium. Day 1, year 10, you want that 250,000 back, we'll give it to you, no questions asked. So just a great, easy, simple place to put money. One thing I'll mention, chargebacks. This is a 3-year chargeback. So, you can tout the liquidity of this thing because it's got 10% free withdrawals. It's got 60% loans. I mean, it's the money's there for you. So if they ever wanted it back, obviously it's there, but just be on the lookout for that chargeback.
Yeah, long chargeback periods are pretty common with return of premium.
Yeah, exactly.
Policies. So, obviously you don't sell these to have the client take the money out. It's more of a, insurance on your insurance sort of thing. What are the qualifiers on this as far as getting access to the long-term care benefit? Is it 2 out of 6 ADL or?
Correct. Everything we talked about today is going to have pretty much the triggers are exactly what traditional has. 2 of the 6 ADLs, activities of daily living, eating, bathing, dressing, that type of stuff. So that's the trigger.
Got it. Any other comments on this as far as the illustration goes?
I was just going to say, you can see on the surrender side, on the guaranteed, there's the 250 from day 1. It's always there.
Nice. Yes, that helps because, a lot of people don't know, maybe they have an ailing spouse or someone that's prone to be ailing. And, if that spouse were to pass away, then they might not need that LTC anymore, so they could get their money back.
Yep.
Great. And then we have the Global Atlantic 4 Care and the Gillico and NuaCare, and we kind of lumped these together so they're similar. So let's go over those.
So most people don't know that there are annuity chassis products that are qualified long-term care annuities. It actually is part of we use part of the HIPAA disclosure. It's actually the Pension Protection Act that qualifies these as tax-free payouts for long-term care. So you could literally have a non-qualified annuity. Once again, you're looking for money that's not used for income for these, right? Maybe you've come across somebody who's got multiple non-qualified annuities. You're going to want to pull the one that's got large gains in it, because I'll show you, Mr. Client, how to avoid all the taxes you've built up in this thing if we just qualify, or if we designate this as your long-term care annuity. Because when you trigger it, the payout will be tax-free. So a lot of people don't know that this is out there. It's kind of a niche product, but it's the way they file these products. And we know of 3 of them. There's actually a 3rd one through One America that's got a product as well. And we'll go over that in a second. But essentially, the easiest one to describe is the 4Care product. Mr. Client, you give me $100,000, you get through the first 5 questions, and I'm going to double your money for long-term care dollars. And if you can get through the next 5 questions, I'm going to triple your money. So 100 will get you 300,000 if you can get through these 10 questions. And if you're over 70, you have to do a quick little interview. But other than that, it's all app-based, and you submit it and they issue it. Obviously, not a lot of underwriting because it's an annuity. There's no death benefit. There's no multiplier, obviously, of a death benefit. So, and then also there's inflation riders we can put on these things too. So you can really build these things up.
And a little trick on this, and Global Atlantic acknowledges this and has no problem with it. My understanding is that the 4Care product has an automatic decline if they've been declined by any other LTC policy. So Scott, correct me if I'm wrong, but if you're going to use some of these LTC products, you probably want to take them through underwriting on 4Care first, right?
Yeah, I mean, that's if you'll start to get, when you start to sell these things, you're going to know what to look for. Obviously health is an issue, and yes, to answer your question, you definitely want to go here first, because any declines on anything else, we're going to have to wait another year to get this product. So keep an eye out for that.
Yeah, I mean, you don't want to run it through 4Care just for the sake of it, of course, but
right.
And
I can help.
They might not like, the tire kicking, but if it is a product that's under consideration, you run it through 4Care first and then through the other products. Yeah. And then what do we want to talk about as far as this illustration here?
Yeah, it's a 9-year product. This one in particular, here's a 65-year-old male, 250,000, you can see. And when I talk to any agents on this, you always want to look at their age, obviously. This guy's probably not going to trigger benefits for 20 years, right? Everybody's living longer. People are healthier. Maybe not in the last couple of years, but hopefully moving forward. But, when you're looking at the benefits, try to think of, 80, 85 as an age and looking down on the illustration. So here, let's look 20 years out. You can see he's got over $1.4 million of long-term care benefits, which will kick out over $22,000 a month to this guy. Not too shabby for $250,000 investment and having a fixed product.
My mom entered a long-term care facility in her early 60s. I think she was 62 or something like that. And she recently just passed away in her mid 70s. So, this isn't necessarily an old age thing. I mean, a lot of people like to not think about it, but, there's a lot of things that could end up putting you into long-term care well before old age does it. So
right. Yeah. The old adage is, take 5% of your assets to cover the other 95%. I mean, this is it's an insurance product, right? That's what insurance is for. So, this also in particular has a 5% inflation rider on there. So you can see I put that in there, and that's why the benefits are going up all the way to the right. Starts at 9,000 day one, but he's up in the 22s, 20 years out. So
that's a pretty substantial benefit for 250,000.
Yeah, no doubt. I think a question that pops up a lot too is, well, what if I don't use it? Well, now you've just got a regular annuity, regular fixed annuity paying you 3%. So,
the way I like to say it is that, I was talking to one of our agent partners and trying to convert him to one of these, an LTC disciple. And he was like, I'd never put one of my clients in one of those products because he'd miss out on growth. And it's so funny because, we'll take someone out of an equity-based product, a risk-based equity product, so that they can avoid a loss, and then put them in an index product, which is designed for a better than average chance of a better than average return without the risk of loss.
Right.
but then we won't take them out of an equity-based product or even a CD, to avoid the loss of long-term care. I mean, if how long is $250,000 going to last
Right. Well, and
for long-term care?
especially when we can throw inflation riders on there. I mean, you're building
Yeah.
it in anyway, so it is growing, right? If you need it. So,
And I'll tell you, having worked in this industry a long time, once the money goes away, you're in Medicaid, you're sharing a room with someone.
mhm,
You don't get the choice of the facility you're in to a lot of extent because you're going there based on availability. I mean, I had to
exactly.
go through that with family members, and so much easier when you have the money and you can just be in the nice places and have a private room. So
That's that. Just touching on that, uh, the easiest people to sell these to are the people that go through that
yeah.
whole
Oh yeah.
process, right?
Oh, it's
And
terrible.
they're actively looking for you to sell it to them at that point.
Yeah.
So,
Okay, let's move on. We're talking
okay.
about One America and the asset care. And it comes on a couple different chassis. So I'll let you go and explain that.
hmm they've got two versions. They got a life version and an annuity version. So those are the two. They actually have fixed annuities and an indexed version, believe it or not. Par rates and caps and things like that. Once again, you're not doing it for the growth. You're doing it for the multiplier of long-term care benefits. So there is a version there. I like One America. It is fully underwritten. So be prepared. It's going to take some time to get pushed through. You don't want somebody who's, got health issues. I don't want to say they're a stickler, but they definitely underwrite this. And there's a couple of reasons. It's a very unique product, actually. They own patents on a few things. We can use qualified money on this product. And in fact, you can have an uninsured husband, let's say, use his IRA to fund his wife's long-term care. So there's things like that we can do with this product. Very unique. They also have unlimited benefits, meaning you were just talking about your mom, Anthony. My grandmother was in a long-term care facility for 10 years, and brutal to watch. Her body was perfect, but her mind was gone. So I can't even imagine how much money my father spent on that. But it happens. And, the Parkinson's or the Alzheimer's, an unlimited benefit is attractive to some people. So they've got that. And then we can also put two people on a policy now. So you avoid, two policies and the policy fees and everything that go along with that. It is a second to die. We've got a couple of other products too we're going to go over that are the same joint second to die type policy, but pretty unique in that and I'll show you, I have an example here we'll show of the qualified version. Here's a couple, both are 70, using $250,000 qualified money. So the way this works is they give you a 10% bonus on that money. So the 250 gets 25 thrown on top, and then we dequalify it over 10 years. So you can see the 27.5 being basically fed into from an internal qualified SPIA. I call it a SPIA. It's really a lifetime. I mean, it's an income annuity, but it's an internal qualified annuity feeding the whole life policy. So it's a couple steps to get into it. It's all done in a package, but the client would get 1099 for those 10 years, that 27.5. And you can see, basically three things can happen with these, right? You can die and there's a death benefit. So you can see there's 392 in the beginning and it drops down to the guaranteed 167. And you ask yourself, 167, if I'm giving you 250, well, it's the leveraging and the inflation that's built into this that brings that down. So you'll see that in a second. So that's the first thing that could happen. The second thing happened, you don't want the policy anymore. There's walkaway value, right? There's surrender values right there in that column. You can see it starts at 204 because there's still annuity value in there, and it drops down to the 111 and starts to build. It's a whole life policy. And then the third thing that can happen, obviously, is you trigger the benefits. That's why you're buying this in the first place. Once again, 70 years old, I like to look out a little bit, let's say 10, 15 years. And, this couple can have over $500,000 of benefits. Each would get $75.92 a month right there. This is a 2% a month policy. So 2% of is the acceleration. So it's a 50-month benefit, but we can actually do 4%. So we can accelerate it faster, increase the monthly benefit, but you're going to reduce the benefit period, right? So 4% would be a 25-month benefit. You can do a 3% for a 33-month benefit. So really lots of different ways to design these things. Give me a ring. There are sweet spots on here, so just use me
And
to figure those out.
So what happens when they trigger benefit? There's a premium waiver, right?
Correct. Good point. So let's say for whatever reason, they both need to trigger this in year 5. And you can see we're only 5 years in of the annuity paying into the whole life policy. Well, the nice thing is there's a waiver built in. So waiver kicks in, policy's paid up, and now you've actually got, let's say the benefit here on year 5 is $56.49. But on top of that, now they're going to have 5 years worth of $27,500 coming in as well, because that annuity money has to go somewhere. You could actually have it, paid to you, or just going to pay to the couple, or you can actually have it paid into the policy again and beef up the policy values. So kind of a neat little thing there that happens. What else can I tell you here? That's you can see I've got an inflation rider here as well, so that's why it's increasing. Depending on age, we can do a 20-year inflation rider, or we can do an unlimited. So if they're in their 50s or low 60s, I'm probably going to push you towards an unlimited inflation rider. There's just a lot of little tweaks you can do to these things. So like I said, call me for a quote and I can help you out.
Great. And then we have Nationwide Second to Die and John Hancock. And this is, so I'm actually going to get this nationwide policy. I always told my kids, if I end up in a long-term care situation, there's a favorite cliff I like to sit on when I'm hunting to look for animals. And I told them just to put my wheelchair with the wind behind me and unlock it and give me a little push. That was my long-term care solution. But, being more reasonable, I'm looking at this Nationwide Second to Die for my wife and I, so that I can also cover some death benefit if I don't end up using it for LTC. So let's go into these two.
Yeah, exactly. So those first two, obviously, we've got the annuity versions. You've got the really simplified National Western product that's kind of a little bit of everything. Then you've got these, which are really, life insurance focused, because you're really doing a life insurance policy with a long-term care rider on top of it. So there's no inflation. We can't build, we cannot build in inflation or anything. They're static benefits. So day 1 benefit's going to be the same as year 30 benefit. But the death benefits are going to be a lot higher, right? Because we're built off of, it's just focused on the life insurance. So we can accelerate the same thing, 1, 2, or 4% with these. Commissions are 90% of the target, just like pretty much any other life policy is. And you've got those 3 things that can happen, right? You can die, you can walk away with some cash value, or you can trigger the benefits. And I think we have an example here. Nationwide.
Using 500,000 on this one, right?
Actually, it's a
million total, right? Okay.
$1 million total. You can see it's a second to die, so there's no payout unless they're both gone. But they each get $500,000 worth of long-term care, and it's paid out monthly, like I said, depending on how you want to accelerate it. And I'm using 2% here, obviously. And you can see it's about a $19,000, $20,000 premium for $1 million. Nationwide really is the only one there might be another one, but the only one joint policy that we can put long-term care riders on. I did include the Hancock one in here because their pricing seems to be a little bit better for individuals. So if you're just doing an individual with a long-term care rider, I like that policy. But they work similar. Life insurance, pretty straightforward. Guarantees built in, non-guaranteed is really the side you want to look at. We have indexed versions and we have regular UL versions.
Yeah, the John Hancock is a percentage of death benefit payable on a monthly basis, right?
Correct. Yep.
And then the nationwide, is this a lump sum benefit, or is
It's the same. Nope, it's paid out. That's the total long-term care amount that you would get is what they're showing you there. So you're getting half. You're splitting the death benefit up in half, but it is paid monthly. Mm-hmm.
It is paid monthly. So you just take this $500,000 LTC benefit and then you divide it over a certain number of months. 50 months. Okay, got it.
So 2% equals 50 payments. 1 would be 100 payments, right? Or 4% would be 25 payments. So it just does. It's how big of a monthly payment you want. And I think the page above shows you what this one was. This one, I think I just did 2.
And so all of these are for basically non-qualified money, except for the One America, which has the ability to convert qualified money into a non-qualified tax-free benefit for the purpose of long-term care.
Exactly.
To do it on a product like Nationwide here, we'd have to set up a qualified SPIA and then manually transfer the funds over to this policy.
Exactly. We could use, it's another sale for you, right? Sell them a qualified SPIA and feed the money in. And we could do a 10-pay, these things are very flexible too, remember. If you want to accelerate the premiums and feed it in over 10 years or 20 years, or even single premium, that's kind of what the One America and the National Western product is for. That's built for single premiums. So lots of different ways to do this, lots of ways of funding.
And on this Nationwide policy, you can see it builds up some decent accumulated value too. So have you run illustrations where we're using the accumulated value to pay the premium, and how long does that last usually? What does that look like?
We can do, that kind of goes hand in hand with doing a 10-pay or a 20-pay. We can accelerate the payments, or like you said, sure, stop the payments 25 years out, start pulling some money out and pay the premiums that way. There's lots of different ways we can fund it. That's all goes into the design, obviously. When you can talk to me and help me understand what the client has and what they're trying to do, and I'll point you in the right direction to go. So, through all of these products.
Yeah. And well, thanks for everybody for joining us today. And, to end on Scott's note there, case design and sales process is a very important part of what we do. My opinion on marketing is it's just an opportunity to demonstrate skill, and it's just an expense until you monetize it through your skill. So your skill is not completely dependent on you and our partnership. You come to us with a fact finder, and then we find the solutions to your client's problems and then developed illustrative case designs. We do all the work for you as far as that goes, show you how to build it, show you how to sell it, give you access to our proprietary software that we've built out, and hold your hand through the whole process. So, in my opinion, when you're looking at your annuity business, a lot of you could probably double your volume just with proper case design and sales process. If your average case size is around 100 to 150,000, we have partners with average case sizes in the $400,000 range. So that's a way to increase your business without increasing any marketing expenses whatsoever. And Scott Soares is one of our experts in the field of life insurance and LTC. We have another fantastic person on our staff, Heather Schreiber, who is an expert in all things Social Security, estate planning, charitable giving. I mean, I could go on and on. Basically, our own personal ed slot in our business that helps us out. And some of these long-term care cases involve estate planning and Social Security planning and things like that. So we have Heather on retainer, and Scott's part of our team to be able to help you out with all those things. So no case is too small or too big for us. We'll be glad to help you. Scott, thanks so much for joining us today. It's been a real pleasure, and I learned a lot. I hope all you guys did too. And call us if you need anything, or come go get information at annuityagentsialliance.com. Telephone number is 888-742-4368, extension 100. Thanks a lot, guys. Have a great day.
Thanks for listening to the Annuity Agents Podcast with Anthony Owen. For more information on how Annuity Agents Alliance will help you build your annuity business, go to annuityagentsialliance.com. If you're watching on YouTube, please do us a favor and don't forget to hit that like button. Also, don't forget to subscribe and ring that bell to be notified of future podcasts. If listening on a podcast channel, please leave your rating and review if you like the show. The information and opinions expressed here by third parties or guests are believed to be reliable, but the information cannot be verified or guaranteed by Annuity Agents Alliance. The opinions of guests do not necessarily represent those of Annuity Agents Alliance or its partners. The prior information does not represent tax, legal, or investment advice, and is for licensed financial professional use only.